Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Wednesday, the 15th of January 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook on the broad-based cross asset classes, ranging from the major dollar pair, the major stock indices, as well as the two key commodities that we cover on a daily basis, which is gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of the intraday performance of the broad-based cross asset classes, and as well as key news flow data releases as well. Okay, so let's start with the intraday performance on the broad-based cross asset classes, starting with the FX market. So if you look at the FX market yesterday, was a rather sideways market over here. So this is the 5-day rolling performance chart of the dollar against other major currency. So what we could see over here is that ever since the push up on last Friday, and thereafter the market, the dollar strength starts to go sideways on a very short term basis, intraday basis. So the one that is still rather strong will be the dollar against the sterling. That means, i.e., the sterling is the weakest currency among the major currency against the dollar. That means dollar strength yesterday is still remains strong against the sterling, whereas the other currency pair against the dollar starts to go sideways. So one of the reasons why the dollar strength dissipated yesterday on the intraday basis is actually due to the one of the so-called tier 2 inflation data from US, which is the PPI data. So PPI data yesterday we call it producer price index. So think as this something like a cost of goods where US firms got to actually purchase to run their businesses. So that's the best explanation for PPI. So core PPI data that's excluding the volatile item like energy came in slightly below expectation at markets expecting 3.8% year on year for the month of December. It came in at 3.5%, a similar rate of growth compared to the previous month of November. So that kind of suck out the dollar strength on the intraday basis against the other currency, with the exception of the sterling, which remains weak against the dollar on the intraday basis yesterday. So later I'll touch on more on the intraday technical outlook on the various major dollar pair. And what we could see over here is that the dollar yen continues to remain hesitant below a key resistance level at around 158.60, 158.60, 158.80, due to the fact that there are several Bank of Japan officials that are giving kind of a rather lukewarm hawkish signal that this coming month of January, which is 2 weeks from now, that very likely potentially I would say Bank of Japan could continue its normalization monetary policy by hiking rates on a very minute basis. All right, a slow gentle hike in Japan interest rate, so that actually preventing the dollar strength from breaking up above the 158.60, 158.80 near term key resistance zone. Now back to that's the intraday performance on the FX market. And what we could see now over here is the US stock market. So the US stock market was rather a mixed bag yesterday. So later I'll explain to you all why the Nasdaq 100 underperformed, whilst the Dow Jones actually outperformed together with the Russell 2000. So what we could see over here is the Nasdaq continues to actually underperform yesterday for the second consecutive session since Tuesday. All right, so since Monday, Monday. So it's down by a slight loss of negative 0.13%, whereas the Dow Jones and the Russell 2000 managed to close positive and outperform at 0.5% and 0.1%. and the SPX managed to actually gain slightly higher at 0.11%. And if you look at the heat map of the the heat map, where is the heat map? Okay, pardon me, I think I just close it. Is it over here? Yeah, this is the heat map. Okay, so if you look at the heat map of the S&P 500, what we could see over here is that we see a slew of red in the mega cap stocks, all right, where Microsoft underperform, Apple also underperform, Nvidia is down the most. I was down the not the down the most. It underperform, one of the underperformed cohort within these 7 mega cap stocks, down negative 1.10%. The worst hit was Meta, Facebook down negative 2.3%, and followed by Tesla as well, down negative 1.7%. So that actually causes the Nasdaq to underperform because these 7 mega cap stocks has a higher weightage in Nasdaq versus S&P 500, but they do not have a significant weightage on the Dow Jones Industrial Average. So the Dow Jones Industrial Average actually outperformed yesterday is due to a very strong, robust intraday performance by the US financials, JP Morgan, Wells Fargo, Citibank, Goldman, as well as Goldman Sachs, which is up 1.52%. And if you look at the Dow Jones Industrial Average over here, the biggest weightage stocks was in fact Goldman Sachs, which is up, which has a highest weightage of 8%, not Nvidia, Apple, or Microsoft. So that actually explain why the outperformance of the Dow Jones over the S&P 500, Nasdaq outperformance of the S&P against that explained the Dow Jones outperformance against the Nasdaq and the S&P 500 yesterday, and also in anticipation of today's key event, which is pertaining to the start of the unofficial start of the US earnings season, Q4 earnings reporting season, kickstarting with the major US financial stocks. Today I'll share with you all what will be the expectation of the market expectation on these earnings for these US banks and financial company that could potentially increase the volatility of the, especially the Dow Jones Industrial Average, which is in our platform we call it the Wall Street 30 in today's intraday session. All right, so that potentially sums up the intraday, we call it performance of the key cross asset classes, which have covered the FX market and the major US stock indices. And some key news flow I want to highlight over here is pertaining to the ongoing frosty relationship between China and US. So even before Trump comes into play or comes into officially in office on 20th of January, which is next week, Biden in the last few weeks of his outgoing administration continues to toughen its stance against China by invoking another ban on China's smart car technology in US. So what you can see over here is that it seems to us that the relationship between China and US is still on the frosty ground, and if Trump's were to come into play, that particular frosty relationship could kind of potentially reinforce if Trump's were to actually fulfill his so-called campaign policy that he wants to have a tougher stance on trade tariffs targeting towards China by imposing as high as additional 60% on China products coming into US. But however, there are some camps within his administration who believe that having a much more higher trade tariffs on China could have a negative boomerang economic effect back into the US economy. And this camp over here is none other than Bassett over here, which is the upcoming the incoming US Treasury, which has which seems to be he is actually a capitalist background from Wall Street, so he do have a lesser kind of a pragmatic approach in tackling Trump's trade tariffs, we call it plan towards US trading partners. So under Bassett, which is this less hawkish trade tariffs camp, actually advocates for a gradual tariff hikes under emergency power. So what it means that instead of imposing 60% outright on China products coming into US, he proposed, or this group of pragmatic group proposed a less hawkish approach by gradually increasing the tariffs hike towards China, hoping that US will be able to gain a better leverage during the negotiation process. And we see how this particular we call it style of trade tariffs implementation got to play out after 20th of January. Because right now things are still rather in the flux, uncertain on how Trump is going to actually lay out his trade tariffs strategy or implementation strategy towards US trading partners. But for sure, before any certainty is being played out, we know Trump's tends to keep people in a surprise mode, and that could also potentially induce higher volatility on the global markets in Q1 this year. All right, so that sum up the first segment on today's Daily Dose of Market Insight. So let's now move on to the second segment, which is going to cover the intraday technical outlook on the broad-based cross asset classes. So let me expand my screen so that you guys could have a better view on the chart as usual. Okay, so let's start with the FX market first over here. All right, so before I start the FX market, yeah, this is a quick recap. We start to see the dollar starts to actually be in a sideways rangy configuration intraday. But however, the long-term catalyst of the dollar strength still remains intact, which is the US 10-year Treasury yield that continues its relentless impulsive up move within its medium-term uptrend since the low of 17th of September last year. And what it did is so far, it continued to print a series of higher high, all right, over here in the last 2 weeks or so, higher high, and its daily RSI already hit the overbought level, but it has not even so-called shaped a bearish divergence yet. So yes, price has really lifted from the 20-day moving average. So potentially, we may see a bit of pullback on a day, maybe 1 to 2 days basis, back to the 20-day moving average over here, acting as a key intermediate support at 4.6 before inching up much higher towards the 5% mark, and going above 5%, potentially we may see 5.2%. And this has a huge implication on global assets. So in terms of a further push up in US 10-year Treasury yield, relentlessly potentially increase the cost of long-term funding. All right. So with a cost of long-term funding in US, that could potentially see the US 10-year Treasury yield widening against the rest of the 10-year sovereign bond yield against the rest of the world. That potentially also supports the ongoing medium-term US dollar strength as well. All right, so with that, now let us take a look at the euro dollar. So the euro dollar yesterday managed to do a squeeze up and broke above our Titan key short-term pivotal support level at 1.027 that we have yesterday. But however, it still remains below the 20-day moving average. So what I'm going to do over here is that first resistance level to watch now is floating up towards the first alternative resistance level after the break of 1.027 will be at 1.0330. I don't put it at so tight for the short-term pivotal resistance at 1.0330. I'll use 1.0375. So 1.3075, if you would do the Fibo retracement of the last push down from the high of 7th of Jan all the way down to Monday's intraday low, that correspond to 76.4%. One technical element, and also correspond to the 20-day moving average that is still downward sloping, and the minor descending channel upper limit that is still in place since the high of 6th of December, all confluencing at 1.0375. So I will use 1.3075 as my key short-term pivotal resistance level, given the fact that today it could be two-way volatility due to the release of the all-important US CPI data. Later I'll touch on that when I cover the last segment of our daily dose. It could induce some kind of two-way volatility. That means either spike up first or spike down. So I don't want to put it so tight at 1.0330. I'll use a higher short-term pivotal resistance level that is being confluenced by three different technical elements. 1.0375 will be my short-term pivotal resistance for today, still having that short-term intraday bearish trend bias on the euro dollar. Two key support level to watch on today on the intraday daily basis will be 1.027 for sure, and 1.027 if you were to do a minor ascending trend line linking the lows of 13th of January all the way up to yesterday's minor swing low. It also corresponds to this minor ascending trend line support as well. A breakdown below 1.027 for sure potentially could expose Monday's minor swing low coming into play at 1.0190. So this is the two key support level to watch on the intraday basis. However, a push up with an hourly close above 1.0375 will invalidate today's intraday trend bearish bias to see a squeeze up for the potential mean reversion rebound to come into play again, exposing the next near-term resistance level after 1.0375 will be 1.044 slash 1.0470. Above it sees 1.0520, which is the minor swing high area of 13th of December and 17th of December. All right, what's up for the sterling dollar? So the sterling dollar continues to hit down and hit our first support level, come break below it at 1.02160 before trading sideways throughout the US session yesterday, but still remains kept below our short-term pivotal resistance, a tightened one that we have yesterday at 1.2260. So pardon me, so still no change, still using 1.2260 as my short-term pivotal resistance level for my sterling dollar. Still maintain the intraday trend bias. Two key support level to watch: 1.2160 again, followed by 1.2080 next, which is correspond to the lower limit of this medium-term descending channel that I drew from the high of September last year, to be precise, 26th of September. So only a hourly close above and a breakout above 1.2260 short-term pivotal resistance for today will invalidate today's intraday trend bearish bias to see the start of another mean reversion rebound, exposing the next near-term resistance level next at 1.2325, followed by 1.2375 slash 1.2405 next. So i.e., in a nutshell, still using this rather tight short-term pivotal resistance level at 1.2260 as my short-term pivotal resistance on the sterling on the sterling dollar to maintain its intraday trend bearish bias. Onwards next towards the Asia Pacific currency against the dollar will be the Aussie dollar. So the Aussie dollar continues to trade sideways yesterday below the 0.6210 short-term pivotal resistance level, and soon to be also coming close to the downward sloping 20-day moving average as well. So if you look at the price action on the hourly RSI, it continues to print a series of lower high, indicating a lack of upside momentum. So still no change, still using 6210 as my short-term pivotal resistance level, maintaining that intraday trend bearish bias, but we do have a higher short-term support level to watch for today on the intraday basis. Will be at this 6160 level. A breakdown below 6160 level exposes 6120 next for today on the intraday basis. However, an hourly close above 6210 and a breakout above it will invalidate today's intraday trend bearish bias on the Aussie dollar to see a squeeze up to kickstart a mean reversion rebound, exposing the next near-term resistance level at 6290 next. I.e., in a nutshell, still using 6210 as my short-term pivotal resistance level on the Aussie dollar to maintain its intraday trend bearish bias, except that I do have a higher short-term first support level to watch out for today on the intraday basis, pardon me, at 6160. Below it exposes 6120 next. Okay, so that's for the Aussie dollar. Now, a dollar yen, like I mentioned, dollar yen can't really have a clear breakout above 158.60, 158.80 short-term pivotal resistance level, as it goes to trap within this minor range configuration that is in place since the low of 20th of December. So continues to maintain that intraday bearish bias within this minor range configuration, as what we could see over here is that the hourly RSI continues to be trapped by this parallel descending trend line resistance as well. And what we could see over here is that the RSI has broken below a parallel short-term support level, right, indicating that a lack of upside momentum. So with that 158.80 short-term pivotal resistance, maintain that intraday bearish bias within this minor range configuration. First support level to watch out for 156.60. A breakdown below it exposes the lower limit of this minor range resistance, coming to act as the next support at 155.95. Only hourly close above 158.80, a breakout above it will invalidate today's intraday bearish bias to see a squeeze up towards the next resistance level at 159.45. Above it sees the major resistance at 160.30 next. So that's for the dollar yen, still maintaining that intraday bearish bias within its minor range configuration that is in place since the low of 20th of December with 158.80 remains as the short-term pivotal resistance level. All right, so that sum up the intraday technical outlook on the major dollar pair. So for today, I want to share with you all one particular FX cross pair to take a look at, will be the Euro Aussie. So the Euro Aussie right now managed to actually trade above the 20-day moving average and starts to be oscillating within this minor ascending channel from the low of 2nd of December. So I'll be using the lower limit of this minor ascending channel as my short-term pivotal support level 166550. Technical configuration is advocating a potential intraday trend bullish bias for the Euro Aussie. Near-term resistance level to watch for today on the intraday basis 16695. A breakout above it potentially may revisit 27th of December minus swing high in first step at 1.6790 next on the Euro Aussie cross pair. Only a breakdown below 165.50 short-term pivotal support level with an hourly close below it will invalidate today's intraday and bullish bias to kickstart a messy corrective minor pullback scenario, exposing the next near-term support level at 164.90 followed by 164.20, which is the minor swing low of 30th of December, and also correspond to the rising 50-day moving average. So i.e. in a nutshell, Euro Aussie hourly chart seems to be evolving into a minor uptrend phase. So for using 1.6550 as my short-term pivotal support level on the Euro Aussie as one of my FX cross to watch to have a potential intraday trend bullish bias. All right, so that sum up the FX market, and now turning our attention will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 squeeze up as expected over here, and what we could see over here is that the hourly RSI starts to shape a kind of a bearish divergence, So with that, I'll be using this. Okay, right now I'll be using 19,340 as my short-term pivotal resistance. So that level has been made yesterday, and with that bearish divergence that's being flashed out right now, potentially we may see a bit of setback on the intraday basis. So flipping to a intraday bearish bias for the Hong Kong 33, i.e. the Hang Seng Index, using 19,340 as my short-term pivotal resistance level. First support level to watch out for will be this region here, this gap up, all right, at 18,950. A breakdown below 18,950 exposes Monday minus swing low, which is coming close to the 200-day moving average as well, at 18,750. Only an hourly close and a breakout above 19,340 will invalidate today's intraday bearish bias to see a squeeze up to revisit and retest 19,580, which is the upper limit of this minor descending channel from the high of 9th of December, and the 20-day moving average coming close to as a support as well. Only a hourly close above 19,580 potentially could validate a start of a mean reversion rebound scenario on the Hong Kong 33 to expose the next resistance level at 20,130 next. So i.e. Using 19,340 for today as my short-term pivotal resistance level, potentially flip to a intraday bearish bias for the Hong Kong 33, i.e. the Hang Seng Index. What's up next, or the Nikkei 225, where in our platform we call it the Japan 225. So still no change. Japan 225 is unable to break above our 38,960 short-term pivotal resistance that we have for yesterday, still maintaining that intraday trend bearish bias using 19,960 as my short-term pivotal resistance level. First support level to watch 38,140, which is the minor swing low on Monday. A breakdown below it exposes 37,990, and below it sees 37,770 next, which is the minor swing low area of 20th of November and 28th of November. And I want to recap that since the low of 20th of September, 27th of September, the Japan 225 has been trapped in this kind of 3 months plus or 4 months, coming close to 4 months plus of sideways range configuration. It can't have a proper breakout on the end of December last year. So only an hourly close above 38,960, a push up above it will invalidate today's intraday bearish bias to see a squeeze up, exposing the next resistance at 39,180, followed by 39,460 / 39,600 next. All right, so that's for the Japan 225. Now, turning our attention will be the German 30 or the German DAX. So the German 30 and German DAX managed to actually store at the first resistance level at 20,330. So still no change, still using the 20,470, 30,520 short-term pivotal resistance level, which is the current all-time high area as well, to have a bearish bias on the German 30, but first support level to watch for today will be 20,060 slash 20,000. Only a breakdown below 20,000 could potentially expose further weakness on the German 30 for it to for the next near-term support level to come in at 19,800, which coming close to the rising 20-day moving average as well. Right, so this is 19,000. Okay, pardon me, 19,810 level. All right, but in order to see 19,810, you got to break down below 20,000. All right, only at hourly close above 20,520 will invalidate today's intraday bearish bias to see a squeeze up towards the main towards this key medium-term resistance level at 20,650, will also correspond to the upper limit of this major ascending channel. All right, this turquoise blue line over here. So that's for the German 30 using 20,470, 20,520 as my short-term pivotal resistance level to maintain that intraday bearish bias. But first support zone to watch, which is 20,060 slash 20,000. Okay, now onwards towards the major US stock indices, starting with the Dow Jones Industrial Average as represented by the US Wall Street 30 in our platform. So price action rally as expected, pullback, our first support and push up and almost hit our first resistance at 42,720. Hourly RSI continue to shape a higher low above the 50 level mark, hasn't hit the overbought level yet. All right, indicating that upside momentum still rather remains potentially intact on a short-term intraday basis. So with that, I will have a Titan key short-term pivotal support for today, 42,200, breakout above 42,710, potentially may see 42,960 next. On the near term, above it sees 43,160 slash 43,350, and also a breakdown. However, if price action start to break down below 42,200, it may revisit the major support level at 41,840 slash 41,770. Why this major support level is important? Because of this green line here. So what's this green line? This green line, if we were to look at it on a daily basis, this is in fact the major ascending channel from the low, major ascending channel support that is still in place from the in place since the low of 27 of October 2023. So back to the hourly time frame chart. Okay, only a clear breakdown below 41,770, then that could potentially kickstart a kind of a multi-week corrective decline. In first step, exposing the next near-term support level at 41,590, followed by 41,330 next. All right, so i.e. For today, using a Titan key short-term pivotal support level on the US Wall Street 30, 42,200 short-term pivotal support to maintain that intraday bullish bias. And bear in mind, it could have a higher volatility coming into a play on the US Wall Street 30, given that the Goldman's, given that it has a potentially feedback loop from the release of today's key US financial bank Q4 earnings result. Next data I'll share with you what are these banks to look out for. All right. Now onwards will be the Nasdaq 100. So the Nasdaq 100 managed to actually squeeze up, hit the first resistance, and thereafter starts to pull back, hit the first support level and starts to whipsaw around it over here. All right, over here, tighten it. So at 20,700 level mark. Okay, 20,700. So with that, we will still use 20,560, 20,530 as my short-term pivotal support level to actually see a potential bounce within this minor descending channel that is still in place since 18th of December. So as long as 20,560, 20,530 short-term pivotal support holds, we'll still have that intraday bullish bias within this descending channel for a potential mean reversion bounce scenario to take hold. First resistance level to watch for sure will be 21,040. Only a breakout above 21,040 exposes 21,200 slash 21,270, which correspond to the downward sloping 20-day moving average, and as well as the upper limit of this minor descending channel that is in place since the high of 18th of December. Only a breakdown below 20,530 will resume the impulsive downward sequence within this minor short-term downtrend phase of the Nasdaq 100, exposing the next near-term support level at 20,335. Below it sees 20,140 slash 20,050, which is also the lower limit of this minor descending channel. So i.e. in a nutshell, still using 20,560 slash 20,530 as my short-term pivotal support level to maintain that intraday bullish bias of that minor mean reversion rebound scenario to play out on the Nasdaq 100. All right, so that sum up the intraday technical outlook on the various various major stock indices globally. So now with that, let us focus our attention to the commodities markets, starting with gold XAU/USD. So for gold XAU/USD, it managed to actually stay below the 2,690 short-term pivotal resistance level. So still no change, still using the 2,690 short-term pivotal resistance level for gold for today, maintaining that intraday bearish bias within this minor ascending triangle range resistance that is still in play since the low of 14th of November. Near-term support level to watch remains unchanged for today at 2,640, 2,640, 2,650 slash 2,640. Only a breakdown below 2,640, which is the 20-day moving average, exposes the next support level at 2,616, which is very key. Why? Because 2,616 is in fact the lower limit or the support line of this minor ongoing ascending triangle range configuration that is in place since the low of 14th of November. All right. Now, only an hourly close above 2,690 and a breakout above it will invalidate today's intraday bearish bias to see a squeeze up towards the upper limit of that minor ascending triangle range configuration. Next resistance level to watch 2,705, followed by 2,716, 2,728, which is the key resistance level. That is the resistance level of that minor ascending triangle range configuration. Swing high of 22nd of November and 12th of November that previously got rejected. All right, so net in a nutshell, still using 2,690 as my short-term pivotal resistance level to maintain that intraday bearish bias for gold XAU/USD within its minor ascending triangle range configuration. Now, lastly will be West Texas crude oil. So West Texas crude oil continues to inch downwards as expected below our 7, 9, 10 short-term pivotal resistance level that we have yesterday. Hourly RSI continues to remain bearish as going to trace out a series of lower high. Now it's trading below the 50 level mark and hasn't hit the oversold region yet on the hourly RSI, indicating that some form of intraday bearish momentum still remains intact. So still no change using 79.10 as my short-term pivotal resistance. A breakdown below the first support level that we highlighted yesterday, which is testing right now at 7756, may expose 7670 next. So 7670 is in fact this dotted gray line here, which is the pullback support line of that former major descending triangle resistance. If you go to the daily time frame, that could be very, very obvious over here. Right. Okay, you could see. So previously there was a major descending triangle resistance that is from the low of 20th of March 2023, and it managed to stage a bullish breakout on this Monday. And right now, price action is trying to pull back to test this level again on the intraday basis at 77.60. Only a breakdown below 76.60, pardon me, exposes the 200-day moving average, which confluence with the next minor graphical support zone at 75.30/75.80. Only an hourly close above 79.10 for today will invalidate today's intraday bearish bias for that mean reversion decline scenario to be cancelled as well, to see a squeeze up towards the next resistance at 80.30/80.90 in the first step. So i.e. in a nutshell, still using 79.10 as my short-term pivotal resistance on the West Texas crude oil to maintain that intraday bearish bias for that potential mean reversion decline to play out below 75.60 exposes 76.70 next. Right, so that also sum up the intraday technical outlook on the various broad-based cross asset classes. So as usual, before we go, let's have a quick look at the calendar to see what are the key data to look out for other than US CPI data that is out later during the US session. So for today, will be Wednesday. If you were to look at today, other than the US data, we do have UK inflation data as well. So core inflation, market is expecting a slight downward tick to 3.4% year on year. So anything data that came in below expectation could actually induce a potential downside volatility on the sterling dollar pair. Okay, something to take a look out for at 3 p.m. Singapore time. Then we also do have retail sales coming up in UK as well at similar timing at 3 p.m. Right. Then thereafter, we do have a ECB official speaking, ECB Gandos speaking at 4 p.m. Singapore time. And next will be the all important core US inflation data that is out at 9:30 p.m. Singapore time, where market is expecting almost the same rate of change or same rate of increase as the previous month of 3.3% year on year. So market is expecting another similar print of 3.3% for the month of December. Something to take a look of. And we have two Federal Reserve officials speaking after the release of the US CPI data, which is Fed Banking and Fed Custody speaking at 10:20 at 11 p.m. And thereafter at 11:30 p.m. we do have the weekly crude oil stockpile change for the week ending of 10th of January that could also impact the intraday movement of West Texas crude oil. And also we do have OPEC monthly report out as well today. Timing wise is still uncertain. There's no timing yet. Very likely to be released during the US session. And at 12 a.m. and 1 a.m., we do have a series of Federal Reserve officials speaking. Fed Williams and Fed Goolsbee speaking at 12 a.m. and 1 a.m. And before the start of our daily dose tomorrow, we do have a key second tier Japan inflation data, which is at 7:50 a.m. Singapore time, Japanese PPI that could impact the Nikkei 225 and as well as the dollar yen rate. And after that, 8:30 a.m. Australia labor tier 1 labor market data, the unemployment rate and the unemployment change that is out at 8:30 a.m. Singapore time, where the unemployment change market is expecting a low ball number at 15k versus 35.6k jobs added in the previous month of November. So something to look out for that could potentially impact the Aussie dollar. All right. So with that, that also take us to the all important US earnings reporting season, unofficially kickstarting today before the start of the US session. So let me take you over here. What are the banks that are reporting today? Okay. So today's will be the Wednesday. So what I could see is that very clear JP Morgan, Wells Fargo, and Goldman Sachs, BlackRock, and Citigroup. 1, 2, 3, 4, 5. Five of them will be reporting today, and Goldman Sachs has the highest weightage in the Dow Jones Industrial Average. So market is expecting a rather, we call it a strong earnings season for these banks over here. If you look at the FactSet report over here, so this you can Google it, it's free. So based on FactSet findings, market is actually looking at for the banks 187% year-on-year growth for Q4 earnings growth. And overall, for the entire Q4 earnings reporting season, financial sector as a whole on the S&P financial sector is looking at a stellar growth of 39.5% year-on-year for Q4. So that actually has been already reflected in the bullish price action behavior of the Dow Jones Industrial Average, which is the US Wall Street 30. Why? Because of Goldman Sachs has the highest weightage in the Dow Jones Industrial Average, which represented our US Wall Street 30 yesterday. They have been rallying since the start of this week. So will it continue to rally further? That potentially depends for sure on the earnings result that could come out later outwards towards JP Morgan, Wells Fargo, Goldman Sachs, BlackRock, and Citigroup. That is going to be out later before the start of today's US session. So something to take note of as well that could induce two-way volatility into the major US stock indices, especially on the US Wall Street 30, which is representing the Dow Jones Industrial Average. Okay, so with that, that sign out. That's actually we call it ends today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.